the giants like Apple, Amazon, and Google. They all started in a room, an office, or a garage. From their first days in business, they grew, thrived, and then took a very public leap, transforming from an insider's club to a public powerhouse. This is an initial public offering, or IPO, the process where a private company officially offers its shares for public purchase, opening its doors to a broader world of investors. For a company, an IPO is a major milestone, often marked with celebration, anticipation, and the promise of expansion. But behind the headlines, beyond the ringing bells on Wall Street, is a long process, packed with filings, market strategies, and sometimes years of preparation. So let's dive into how IPOs work and what really happens behind the scenes. Taking a company public is no overnight event. The IPO process can take months, even years, and it's packed with critical steps that often bring private companies under the public spotlight for the first time. It all starts with a single form, the S-1 registration, which contains a filing called a prospectus. This filing, submitted to the U.S. Securities and Exchange Commission, or SEC, unveils key details about the company's finances, business model, and other once private information to the public. It's a moment of revelation, giving potential investors a peek behind the curtain, and it's a requirement for any company hoping to join the public market. The next step? Bringing in the experts. The company hires investment bankers, whose main job is to help set a valuation, estimating the company's market worth, and assist with the finer details of the IPO. For their work, these bankers earn about 7% of the IPO's gross proceeds, compensation for both matching investors with the company and setting an effective price for the stock. From there, they'll receive hundreds of bids and decide which of these bidders will make the best group with a strong investor base, balancing price and the desire for long-term investors who won't sell their shares on day one. Then, the night before the company's IPO, after a grueling and tedious process, investment bankers make the final call on who gets the first shares, aiming for a mix of buyers who will ideally boost the stock's performance. The IPO prices that night, then hits the public market the next morning, where anyone can buy shares from individual to retail investors. From there, the amount of money the average IPO raises varies significantly each year. In 2021, for example, the average IPO raised roughly $354 million. Whereas in 2022, when the IPO market had cooled, the average was about $98 million. Now, IPOs might seem like a modern marvel, but the idea of going public actually dates back centuries. The first company to sell public shares of its stock was the Dutch East India Company in the 1600s, when it offered a slice of its business to the public on the Amsterdam Stock Exchange, pioneering an entirely new financial model. In the US, public trading didn't start until the 1790s with the launch of the Philadelphia Stock Exchange. But in 1792, just 2 years later, the New York Stock Exchange was founded, and soon after, the Bank of New York became its first publicly traded company. Since then, thousands of companies have gone public on US stock exchanges, with the market reaching a peak of over 7,000 companies in 1996. Today, that number has been cut nearly in half. But what's the allure of a company going public? For many, going public offers significant advantages, with the biggest being access to substantial capital, providing funding to expand operations, launch new ventures, hire more staff, or pay down existing debts. An IPO can be a financial game changer, offering a company the resources it needs to grow. But there's a catch. Going public means giving up a certain level of control. Once shares are available on the open market, anyone with the money can buy in, potentially gaining enough stock to influence the company's direction. Public companies also face strict reporting regulations, including quarterly earnings reports that detail company performance. This transparency can bring scrutiny, as every decision becomes visible to investors, competitors, and the public. Additionally, these disclosures are costly, requiring significant resources to manage. In the end, an IPO can be a thrilling milestone for a company, offering access to new capital and an opportunity for growth that's hard to match. But it's also a high-stakes move, requiring full transparency and public accountability. For many companies, the rewards of going public outweigh the risks, but the journey is one of careful planning, intense preparation, and the hopes of making a strong debut. Visit the resources below to dive deeper into some of the lesser-known aspects of IPOs, and if you learned something new in this video, consider subscribing to our channel for more content like this.